this is just the typical statement that is made between any time that we have some kind of presentation like this. This is for educational purposes only. I will tell you what I know, and it is correct, but you should always seek qualified advice before you make any kind of, major decisions. Briefly, we're just going to kind of hit on where we're at financially right now. In the farming world, we're going to be talking about it from the 30,000 foot view, speaking in averages. I'm going to spend a little bit of time talking about the Paycheck Protection Program and some of the challenges that we may be faced with that as far as making decisions. And then we're going to talk about some other tax considerations and other tax strategies. I did have some questions that were provided to me before this presentation. Some of those will be answered hopefully during the presentation, but at the end, I will also cover any of those that I did not hit already in the presentation. But then I would also like the opportunity to answer any other questions that may come up as we move along here. So how has COVID-19 impacted farm finances? What a crazy year, and it has been a very crazy year for many, many reasons. But what I did was I just pulled some USDA projections as far as what they expect, what they expect farm income to look like for 2020. Now, we all have our own opinions on how reliable this information is, and these are projections. They don't always get it right, but oftentimes the trends that they show hold out to be correct. So here it just shows that net cash income and net farm income are expected to be up for 2020 as opposed to 2019. The interesting thing about this is if somebody had asked me, the beginning of 2020, what's it going to look like on farms, given the COVID situation, given the relatively depressed prices in the commodity markets, I would have said that it would be a rinse and repeat of 2019 or possibly worse. So it wasn't until we started getting some of these government payments and the commodity markets changing that, we realized that we may actually have some tax implications. These other few slides here are just more just kind of interesting to look at as far as the USDA projections are concerned, as far as how cash receipts are going to change in a projected format from 2020 over 2019. And for the most part, you can see corn is projected to be slightly less, but soybeans, fruits, nuts, vegetables, and melons, the sales are expected to exceed the previous year, and then wheat and cotton are kind of holding their own there. As far as the animal side of this is concerned, dairy products and milk, surprisingly, at least to me, is holding its own. Hogs, not a big decline. Cattle and calves, not a huge decline, but the broiler market is projected to take a pretty big hit. But this here is the most interesting slide, in my opinion, and it just shows direct government payments to the farms from 2015 to 2020 and projected for 2020. And we had them MFP payments back in 2019 that were tapering off in 2020, but you can see that all the other program payments, so this is primarily going to be CFAP or the coronavirus food assistance programs and Paycheck Protection Program payments are what make up that big increase there in the projection for 2020. And then we can't just look at it from one side, right? This is what the income looks like. What does the expense side look like? Essentially, the expenses are expected to be the same or slightly down from the previous year. So we haven't seen a huge decrease in any major input prices, though we may, depending on what part of the country you're in and what fertilizer prices you're looking at, fertilizer prices are starting to go up. So before we get into talking about income tax strategies and things specifically, I want to spend just a moment or two or a few moments speaking about the Paycheck Protection Program, because there are some issues here that may catch us off guard if we're not careful. Um, there's no doubt that these things have created, I mean, they were a blessing to have that influx of income, or funds, I should say, for farmers, but it's also created plenty of challenges for farmers, lenders, and accountants. Um, the initial term was 2 to 5 years, but then forgiveness is possible for most or not all of your PPP loan if certain criteria are met. So if this money is being used to meet payroll, rent, interest, and some utilities, there's some stipulations there. But, a lot of people are interested in getting these PPP loans forgiven, and I encourage everyone to do that. Just real quick, just to give everybody an idea of what the total PPP loan looked like. Just over 5.2 million loans went out. 5,460 lenders were involved in that. You can see the lender size, the net amount of dollars that each of these lender classes sent out. Nothing groundbreaking here, just kind of interesting to see some of that information. I know this is tiny on your screen, but still you can see who got what as far as number of loans. And this was as of August 8th. And we see where we at. 89,615 in Wisconsin. And then the average overall loan size is $101,000. And this just gives us the breakout here as far as different ranges of loan amounts and what percentage they made up. Just, like I said, nothing groundbreaking here, just kind of interesting to look how some of this data has been summarized. So one thing that we do know is that typically, so if we're thinking about these PPP loans in the forgiveness perspective, so we're going to do all the steps that we need to get these loans forgiven. Typically, when we think about a forgivable loan, then we have to concern ourselves with cancellation of debt income. However, the CARES Act expressly stated that the forgivable portion of the loan would not be subject to cancellation of debt income. And so I asked the question, is this too good to be true? And it isn't too good to be true on the sense that it's not going to count as cancellation of debt income, but there is some concern about on the expense side of that. Specifically, I don't know why my slides are frozen on me here. There we go. We'll talk about that just in a second. So eligible expenses that meet forgiveness criteria were ordinary business expenses. We don't have to concern ourselves with the cancellation of debt income, but we have this IRS Notice 2032, which is what I quote unquote call the wet blanket. And what the IRS Notice 2032 tells us is that we cannot count the deductibility of those expenses if they were forgiven under the PPP loan arrangement, because the IRS argues that this is a double benefit. So essentially the IRS says if we're not going to hit you with cancellation of debt income, then you don't get to count those expenses that were forgiven with that. Because if we did that, if we didn't do the cancellation of debt, but you also got to count the expenses, you would have a double benefit. Some of the Congress individuals involved in the creation of the PPP argued that this double benefit was precisely what was intended. And so not a big shock there. I mean, this is the way laws are made all the time in this country. A law is written, or Congress comes up with an idea, the law is written, and then different regulatory bodies interpret that law and try to interpret what Congress's intents were. So it's not that unusual to have this kind of an issue. The problem is it just creates frustration for those of us on the other side of it who are trying to interpret these laws and how these laws apply in these different regulatory bodies. And ultimately, what is this impact is this going to have on our taxes? So right now, without further legislation, it appears IRS will not allow forgivable expenses to be deducted. So that is something that we've got to keep in mind when we're doing tax estimates. So in other words, businesses may be liable for the taxes on what would have normally been those ordinary business expenses that have been forgiven under the PPP loan. So this is an implication for estimated tax payments. If you make estimated tax payments, which I know a lot of farmers don't, but at the same token, several do. If let's say you got $100,000 PPP loan, you used it all for payroll. Now you've got $100,000 less expenses than what you were expecting. All things equal, your income is going to be higher. Your estimated tax payments are not going to be reflective of your actual tax situation, i.e. you could have penalties and interest associated with that. And there's also some implication for fiscal year filers as well, depending on when the expenses that were forgiven could be counted versus when the forgiveness happens. And this actually kind of holds true for calendar year filers as well, depending on when you actually do the forgiveness or apply for the forgiveness of your loan. So one of the question is, how do we handle this? And honestly, the answer is nobody knows for sure. Do you go ahead and count those expenses and then worry about it later? My advice to most people right now is if it's pretty sure that you're going to get the loan forgiven, just go ahead and get the forgiveness, but also don't count those expenses unless you've got some strategy in the future to try to offset that. Then we also have to concern ourselves with how do we properly record these PPP loans on financial statements, especially the balance sheet. If we're not going to, if this PPP loan stretches out over more than one accounting period, and then how do we report the forgiven portion? Now, remember, this is not, this question here of how to report the forgiven portion is not a tax issue, but just a financial reporting issue. And places like the Farm Financial Standards Council is working on this right now to try to determine what is the appropriate way to do this. So I guess I'm saying just stay tuned, but just know that if you're doing your own books and your own financial reporting, this is something you're going to have to struggle with. And then if you have somebody else provide these services for you, this is something that they're going to be struggling with, is where to report this on the financial documentation side. Because we got to keep in mind things like benchmarking and financial ratios and consistency therein. So let's talk about some other farm financial management considerations. We've already touched on this a little bit, but the interesting thing to say it that way is it's a mixed bag out there for farmers as far as COVID-19 is concerned. Of course, we had supply chain issues that really slowed down moving animals in a lot of cases. The dairy sector was hit. But then we've had these volatility in prices as well, where especially as of late on the commodity side, as far as beans and corn are concerned, we've seen a rally that was unexpected. But how much of that was actually captured is a good question. I know a lot of the folks that I work with had no expectation. There was no indications that we would see significant changes in corn and bean prices, for example. So they were 60-70% marketed before the rally happened. And then we start talking about things like value added and direct marketers may not have been impacted as bad. And in fact, their sales may have grown. But is that sustainable? That's another question. Are consumers going to continue to behave in the same way that they have if after COVID-19 is over? I know here in Kentucky, we've had a major issue getting access to slaughter facilities. All of our slaughterhouses that our direct marketers would use are booked out until this time next year or beyond. Then we also have to concern ourselves with what the off-farm income looks like for operator households as well. Now, this is a little bit dated, but this is the most recent data that the Agricultural Resource Management Survey has available to us through the USDA. But I just show this to point out that in the U.S., on average, 53% of farms have some kind of other income, W-2 income coming in to their operations. So While we may be having a better year on the farm or a worse year on the farm, then, what's the unemployment situation look like, so on and so forth. So this year is not typical in any form or fashion. All right. Some other things to think about: interest rates are low. Maybe time to look into refinancing or restructuring. So if we are having cash flow issues, now may be the time to do some restructuring and take advantage of some of these low rates. Then I asked the question, what does capital availability look like going forward? What are banks willing to do? How do banks see the farming economy? As far as capital availability going to get tighter? It's already tightened up quite a bit over the past few years. Has COVID-19 increased that tightening? We don't know for sure, but something to keep your eye out for. And so I also asked the question, from a farm tax management perspective, what are we trying to achieve? Do all lenders look at income the same? And this will probably be not a surprise to anyone, but no, not all lenders look at the income the same way. You would hope that they did. You would hope that there's a very systematic approach. And while there is to a large degree, a lot of lending decisions are still very much tied to taking a tax return and then making some accrual adjustments to that. So if we're looking at a year where we're having a bad year, we're going to show a loss on the Schedule F, and that's something that we don't want for lending purposes or other reasons. Let's start looking at stretching out depreciation further. Let's not depreciate things in the most rapid fashion possible. Let's slow that depreciation down. And then we can also look at depreciating items normally expensed in a given year. So as we know, farmers are afforded opportunities to take expenses in 1 year on things like fertilizer that may have some benefit beyond a 1 year period. We can depreciate fertility. Maybe that is something that we look at to try to more strategically manage that Schedule F bottom number. Remember that government payments are not deferrable. So if you've received CFAP 1 and 2, you don't really have any opportunity to defer those till next year. Actually, you have no opportunity to defer those till next year unless you receive them the following year. The deadline for CFAP 2 was December 11th or 10th, somewhere right around here. So as long as they get those processed and you get paid in this calendar year, assuming you're a calendar year filer on your taxes, you don't have any option to defer that until the following year. On the other hand, crop insurance can be deferred depending on the specifics of the situation. But if you can show that you would normally sell some of the crop the following year and you have a crop insurance claim, there are some options there to defer part of that crop insurance or all of that crop insurance to the following tax year when you normally would have sold that crop. There's a lot more specifics to that. And anybody that has questions about that, more than welcome to reach out to me outside of this, but just know that exists as an opportunity as well. One of the questions I received before this presentation was concerning prepaid expenses. And so just here quickly, farmers in general are allowed to deduct expenses in the year they were purchased, even if they're going to be used in the following tax year. So in general, you can deduct up to 50% of your scheduled expenses for the year. So let's say that I've had a good year. Some of this CFAP money has made things a little bit better. I'm worried about my tax situation. I can go ahead and buy my inputs for next year up to 50% of what my current Schedule F expenses are, no problem. There are 2 exceptions to this, and this is written in a very ambiguous nature, very subjective. So the IRS says exceptions to this 50% rule are if you've had a change in business operations caused by unusual circumstances. Well, what is an unusual circumstance? The IRS doesn't give us any kind of clear definition on that. But it's honestly one of those slippery type terms that I exploit all the time. Second is if your total prepaid farm expenses for the preceding 3 tax years is less than 50% of your total other deductible farm expenses for those 3 tax years, then you can get above the 50% limit. So I always tell people this is what the rules are, but anytime I'm doing prepaid expenses and they exceed 50%, I don't worry about it too much. But once again, go back to my second slide. Remember, this is for educational purposes only, blah, blah, blah. But honestly, prepaid expenses exceeding that 50% limit is not something that I lose sleep over. Somebody also asked some questions about equipment, selling equipment, how that's taxed. I need to remind you that there's really 2 issues here, that the Tax Cut and Jobs Act changed the way in which we treat equipment exchanges. And essentially what the Tax Cut and Jobs Act did was got rid of like-kind exchanges, basically for everything except for real estate. And so this has some pretty big tax implications as well. So just quickly assume that we purchase a new tractor for $100,000. We traded in a tractor and we were given $40,000 for that old tractor. We only had to come up with $60,000 of new cash, right? $100,000 tractor, they're giving us 40 for this old one. $60,000 is what we either have to pay or finance. Before the Tax Cut and Jobs Act, we would just appreciate that $60,000 new money, so to speak, plus any remaining basis in the old tractor. Now, we have to actually recognize the sale of that old tractor at the trade-in value. So now we have to actually report $40,000 of income from the sale of that old tractor, and then we get to fully depreciate the $100,000 new tractor purchase. What's the problem with this? Well, if we're only dealing with it on the federal side, it's not so much of a problem because we can use either bonus depreciation or Section 179, our 2 accelerated depreciation methods there to reduce these income tax applications. However, not all states are on the same page as the federal government. And in the state of Kentucky, for example, we've been capped at $25,000 Section 179 expense and no bonus depreciation until this year. So while we can handle it pretty easily on the federal side, the state side caused us a lot of heartache when it comes to managing the taxes. Kentucky has now increased that, and I don't know what it is for Wisconsin, but just understand that for states, if they're not on the same page as the federal government, this can create issues because you don't have these accelerated depreciation options. Another question was, what if we sell equipment and buy equipment back? And more specifically, what happens if we sell a piece of equipment that is fully depreciated? The nugget here is that if I sell a tractor for $10,000 that was fully depreciated, I have to recognize that full $10,000 as ordinary income, but it's not going to be subject to self-employment tax. And then if I buy a tractor for $20,000, then of course I get to depreciate that full $20,000 tractor, and I could do that over time, or I could do that all in 1 year, depending on what the specifics are. If depreciation still exists, then the selling price less the depreciation is how you determine the gain. But the big thing here, and sometimes this catches people off guard, especially if they're trying to sell some otherwise underutilized equipment to free up cash, is we get hit with some pretty big taxes sometimes, because these equipment sales are ordinary income. They're not capital gains in most cases. They're going to be treated as ordinary income, but they're not subject to self-employment tax. The only time that you get a capital gain on the sale of equipment is when you sell that piece of equipment in excess of what you paid for that piece of equipment. And then, and only then, do you pay capital gains on the difference between the sales price and what you sold the tractor for. I'm sorry, you pay capital gains on the difference between what you sold the tractor for and what you bought the tractor for, and then there's still going to be an ordinary income part of that as well. So just be aware of that when you sell equipment, we've got this ordinary income situation that we have to concern ourselves with. But the good news on that is self-employment tax is not an issue. So that's a 15.3% savings essentially. The last section here deals with farm income tax averaging. So this applies to people who maybe have not been making as much over the past 3 years, and then all of a sudden make a whole lot in 1 year, which for some individuals, this could be the year where they've made a whole lot more income than what they've had over the previous 3 years. So farm income averaging is just a strategic farm tax management strategy. We use it to smooth tax liability over time. And what happens here is you elect to quote unquote spread the current farm income over the 3 previous base years. And this is done in equal proportion from your elected farm income moved into each of those base years. And what I will say up front here is that I literally could spend 4 hours talking to you about all the ins and outs of farm income averaging. My goal here is just to give you a basic understanding for those of you that have never done it or have never been exposed to it, give you a basic understanding so that you can either contact me to learn more, find other resources to learn more, or go to your accountant to discuss this option. There are a lot of accountants that are completely unaware of farm income tax averaging because it's one of those things that only applies to farmers, and you can't do this in any other business out there. And so it's not utilized a whole lot, but it is out there and is completely above board to do. So bear with me here as we just quickly work through this example. I'm just showing you 3 tax years. So I did not update this for 2020, but the process is exactly the same. The rates may change a little bit as far as what the marginal tax rate is, but the process is exactly the same. But assume that taxable income was $25,000 in 16, $35,000 in 17, and $45,000 in 18. And then all of a sudden, you know, you've had a much better year in 2019 and you get $105,000 net farm income. This shows you what your marginal rates were for each of those years. Remember that we have the Tax Cut and Jobs Act that changed the marginal rate around this area here for 2018. That's why it's so much less. Also, just to note, the 2019 income is not total taxable income. This would only be net farm income, but these 3 figures here would be total taxable income. I'll explain why that matters later, but if you're just solely farming and you don't have any off the farm income, you can think of these all as being the same. But if you do have off farm income, when you go back to average it, you have to average it over all of your income, not just your farm income. So just to show you what the federal taxes would be on 2019 income of $105,000, total federal income tax would be, and you know, just income tax, we're not talking self-employment tax, would be $20,187 or a 19.23% effective tax rate. So if we looked at this and thought of our tax brackets as the cylinder that we're filling up, you can see that $105,000 just pushes us over into the 32% tax bracket. So when you look at this, think about everything below these lines as the percent. So everything below this line's at the 10%, everything below this line's at the 12%. So up here, everything below this line's at 32%. So we've just crossed over this 24% marginal bracket into the 32% marginal bracket. If we did the same thing for 2016, 17, and 18, you can see that we are just into the 15% tax bracket for 16 and 17 and just into the 12% tax bracket for 2018. In other words, we've got $50,300 remaining space in our 16 tax bracket that we can tax at 15%, $40,900 at the 15% for 2017, and then $32,400 remaining in this tax bracket for 2018. To go back and look at 2019, we've actually got $65,525 above the 12% tax bracket for 2019. So what we want to do is we want to take that 2019 income and spread it out over 16, 17, and 18 to use up these lower tax brackets. So we do that. We take our $105,000 of 2019 income, divide it by 3 because we're only allowed to average over 3 years, and it has to be an equal proportion in each of those previous years. That gives us $35,000 of 2019 income that we can go back and quote unquote put into those previous years to tax that income at that previous amount. So if we do that for 16, 17, 18, we're dropping $35,000 in each of those cylinders. This is what the new brackets look like for those 3 years. So what we've effectively done is moved 65,000 plus income out of 2019 at that higher rate and been able to capture these lower tax brackets that we had in the previous years. So I'll show you here, we've lowered our taxes for 2019 with farm income averaging from 20,188 to 14,700. So we went from that 19% effective tax rate down to a 14% effective tax rate. And so we've saved ourselves over $5,488 in taxes just by implementing this farm income tax averaging. So it's a very effective tool that we have. Once again, it's oftentimes underutilized because a lot of people don't know about it. But if you've had years where you've had losses, even so your net farm or your total income are negative, and then you have a year when you're positive, the tax savings on that could be very, very significant. So I strongly encourage people to talk with their accountants and utilize this tool in order to take advantage of this. I'm just going to quickly look over. I think I hit most everything that I was asked before the presentation, except for somebody asked about basically where do we report government payments. So these are things like NRCS EQIP, US FWS partner grants. You're going to get a 1099 on those, and they're going to show up on the top part of the Schedule F in that government payment line. And then somebody asked, should we wait to apply for PPP forgiveness until 2021? That's all going to depend on the specifics of your situation. And so I can't really tell you just as a general rule what's going to be better for you. It's going to depend on your exact situation. The last 2 questions here that I did not answer explicitly in the presentation, I'm sorry, 3. One is, how do we know if we have a problem? How do we know if we have a tax problem? Right now is the time to make sure your accounting is up to date and run a tax estimate. Because if you're a calendar year filer, you only have to December 31st to make any strategic moves that you need to. And then somebody asked also about a good resource for easy to use manual record keeping system. And do you have any suggestions for free tax prep courses, specifically Schedule F prep? There's a lot of free resources out there for tax preparation in general, but I'm not aware of any that specifically focus on farming. And then as far as a good resource for manual record keeping system, record keeping is one of those things that it has to fit the individual. I don't have any resources out there. You can internet search farm record keeping. The most land grant universities have some kind of tool available. I would check with your extension office and see if they can put you in the right direction on that. I don't have a particular favorite record keeping system from the manual perspective. Most of the people that I work with are using QuickBooks or a Red Wing software product or something like that. And then lastly, what strategy should be considered to minimize tax liability while still showing profitability for your lender? I hit on that a little bit earlier, that not all lenders look at everything the same, but one thing that is relatively consistent when looking at when a lender takes your Schedule F, they typically will take your Schedule F and add back in depreciation and interest expense. And so I always encourage people to try to depreciate as much as they can. Let's try to get as many ordinary expenses out of, just an expense line into that depreciation, because that's going to help you long-term spread out that cost but also if we depreciate those items, it will lower, if we're looking at a loss situation, it will lower the magnitude of our loss for that given period of time.